This podcast is not legal advice and should not be relied upon as such. You should always obtain legal advice about your specific circumstances.
Hello and welcome. Thanks everyone for joining today to our latest episode of Tax Records, the podcast produced by the Hall & Wilcox tax team. My name is Frank Hinopoulos and I'm a partner in the tax team. In today's episode, I'm delighted to be joined by my colleague, Special Counsel Jackie McGrath, who specialises in tax disputes and controversy. The topic for today is all about the Australian Tax Office's debt collection powers, including, importantly, the director penalty notice regime. So, Jackie, we have heard all about the ATO SME debt bomb, as I've heard it described in the papers, and the latest data suggests that the ATO's receivables stood at around $15 billion with a B before COVID-19, but have since risen quite dramatically, and current indications are that there may be around $40 billion of debt that is collectible now, and that of that amount, 70% of it is owed to the ATO by SMEs. So in light of that, and in light of the ATO's recent announcement in May 2022 that it will be looking to re-enliven firmer action relating to outstanding debts, it seems like a very good time to be talking about tax debt recovery. But before we get into that, could you please tell us a little bit about what steps the ATO can take in terms of recovering tax debts?
Sure, thanks, Frank. So, yeah, there are a few strings in the ATO's bow, so to speak, in terms of recovering tax debts. But before I go into those, it's probably important to just flag perhaps a few unique aspects of when we're talking about tax debts in particular. And the first thing is that once an assessment issues, it's deemed to be a debt due, immediately due and payable. And what's significant about that is that as soon as the assessment's raised by the ATO can sue upon it. And now an assessment has a particular meaning, as you know, in the tax world, and it can sometimes be deemed to arise when you lodge your return or your BAS. So the very act of lodging your BAS can be deemed an assessment, and so any amount payable on that BAS is a debt immediately payable. But the other significant point is that if, for example, you've been the subject of a review or an audit that's resulted in the issuing of an amended assessment, and you say disagree with the findings and you want to pursue your review rights, the debt still stands. And can be recovered by the ATO, regardless of whether you're sort of exploring those avenues. So yeah, the point I really think is really that assessments can arise by lodgement of returns or disputes, and in either case, their debt's immediately due and payable.
So, Jackie, we talked about some of the avenues that the ATO has, and you mentioned that the ATO does have a number of arrows in its quiver. Could you talk us through what some of those arrows are?
Sure. So the most simplest is, the ATO can agree to a payment arrangement. So basically agree to accept an instalment payment plan over a reasonable period of time. But I should really caveat that while sometimes the ATO are open to this, taxpayers shouldn't assume that they'll be granted it. The ATO will consider a lot of things when they're looking at that: the size of the debt, the compliance history of the taxpayer, so things like whether you've kept up with lodgements of your tax returns or your BASs, that sort of thing. They'll also consider things like whether you can make any upfront payments towards the debt. Those sorts of things. If it's a corporate taxpayer, often they'll look at, your financials, your cash flow forecast to see whether you can meet the proposed payment plan. So that's probably, and I should say the ATO do often look at, as part of any payment plan, also increasingly asking for security over property that the taxpayer might have. So whether that be real property or shares, those sorts of things. But payment arrangements, as I mentioned, is just one option in terms of debt recovery. The ATO have things like garnishees, director penalty notices, and then, of course, more formal court recovery, things like bankruptcies and wind-ups.
Excellent. Well, you and I both have experience across that full spectrum of ATO debt recovery options. And I think out of all of those, maybe the one that, possibly with the exception of court proceedings, that the one that scares people the most would be director penalty notices. So, Jackie, just picking up on that final point about director penalty notices, we've seen the ATO recently announce that they will be increasing their activity in that particular space. Are you able, please, to share any insights on what directors should be thinking about in terms of mitigating their risk in the face of a director's penalty notice?
Yeah, sure. I think the most important thing is to engage with the ATO. If the company has a debt or is behind in compliance, you need to be speaking with the ATO to manage this. It sounds really basic, but it's really, really important. As I mentioned, there's a lot in the ATO's arsenal in terms of debt management, and they can take quite immediate and firm action, where the effects of that action, for example, for a company situation, they can be wound up in insolvency, and what can be done by a business at that point is actually quite narrow. But as I mentioned, if you can negotiate a payment arrangement, then the ATO often agree to hold off taking that firmer action whilst that's in place and can be complied with. So as I mentioned, you can negotiate a payment arrangement and they'll agree to often hold off more firmer action whilst that's agreed and complied with. Now, it's obviously on a scale, right, and a risk assessment's done by the ATO, but one of the factors on that scale is taxpayer behaviour. So whether you engage with them to try and sort it out. Now, I'm not saying that the ATO will agree to a payment arrangement in every circumstances, but what I think would be a fair reflection is that it's going to be much harder for you to obviate the risk of a director penalty notice if you are not taking active action and being proactive with the ATO, not waiting for notices, reminder notices, follow-ups, that sort of thing for the company as well. So being really on the front foot with that. And just another really small thing, but an important thing for companies, and obviously in terms of director penalty notices in particular, is making sure that your ASIC records are all up to date. So ensuring that the listing of the directors who are actively managing the business are on the record, and that's being kept up to date. People who have retired from the business, from the company, again, updating the business address records, because of course, if your business is behind on compliance, the ATO often issue notices based on your ASIC records where you're recorded. So, and of course, businesses move on and change. So you might never receive those notices and things like that. So just having that in place can often really assist.
Thanks, Jackie. I think there's the two bottom line points of what you're saying is that it's never a good idea to stick your head in the sand and try and ignore these things. And the second is that it's important to keep your information and your details up to date. And that's probably good advice, not only in the context of director penalty notices. So, Jackie, I think talked about director penalty notices and what some of the implications might be. I think one situation that arises all too often is that somebody might be a new director to a company and have joined the board of a business or a company with a great deal of enthusiasm. But one of the sort of hidden nasties might be the fact that they can become sucked into a director penalty notice issue. So could you talk a little bit about the implications for a new director with respect to the debts of the company that they are becoming a director of?
Sure. So yeah, that is a common question. So yes, unfortunately, directors do inherit the debts of the company. So you can be issued director penalty notices if the company has outstanding super guarantee, pay-as-you-go withholding responsibilities, and also as of about a year and a half ago, they've included GST debts as well that can be the subject of personal liability on and subject to the director penalty notice regime. So even if you weren't a director at the time that those debts accrued, you do inherit those when you join. There's some steps that can be taken. You do need to do it really quickly, as in within 30 days of appointment. And the first, if a director's joined and becomes aware of the tax debts, and I'm only talking here about in terms of obviating the risk of a director penalty notice, but the first thing that they can do is on behalf of the company, negotiate a payment arrangement or pay the debt, of course, of the company, and that can be done within. If that can be done within 30 days, that's a carve out from the director penalty notice regime. There's also insolvency-related steps that they can take. So again, it has to be done within 30 days of appointment. The director can appoint an administrator, or in the small business context, there's a concept under the corporations law known as a restructuring practitioner. So if you do that, or commence wind-up proceedings, of course, within the 30 days, again, it's quite strict.
And Jackie, what about the sort of opposite end of the coin? What if you have somebody who was the director of a company for a little while or a long while, and then they resign? Can they have any residual liabilities under a director's penalty notice for the tax liabilities of the company?
Yeah, so it doesn't mean that you'll escape personal liability for the tax debts, even if you resign. So you can still be subject to a DPN for that. If the tax debt arose during your time as a director, you can still be issued a DPN for them even after you resign. And there's also a small carve out too, just for completeness. Technically, you can be liable for debts that arise after you resigned for certain pay-as-you-go withholding and GST amounts or super guarantee for the reporting periods relating to a time when you were a director, but only become payable after you resign. So just that small caveat there. But yes, you do remain on the hook even after you resign.
Brilliant. The joys of being a director, eh? So, Jackie, we've talked about director penalty notices, and no doubt anybody listening probably has the fear of God instilled in them now. But so, if you are confronted with a director's penalty notice, are there any defences or practical steps that need to be taken to try and obviate one's liability under one of those?
Sure. So there are defences if you do get issued with a DPN, but they're, to be fair, fairly confined. So for example, if the director can evidence that they didn't take part in the management of the company during the relevant time, and common examples of this is where you can evidence illness or similar reason that you weren't part of the management. Basically, when the ATO is satisfied that it's unreasonable to expect that the person could have taken part in the management of the company, those are the ones that I've seen, and that can be a defence. Obviously, also, if you can evidence taking reasonable steps upon your appointment that I mentioned earlier, so things like appointing an administrator or a restructuring practitioner, to assist the company with their debt management.
Excellent.
But it is quite narrow and obviously dependent on needing some reasonably cogent evidence to make good that defence.
Excellent. No, thanks, Jackie. And I think we continually tell clients, and in the context of a number of matters, that when it comes to these sort of questions, especially where they're evidentiary questions, it matters not so much what you say, but it matters what you can prove, and what sort of documentary evidence that you can furnish to prove some of these things. And I think we all know, especially in the context of an SME type of business, that the the level of corporate record keeping may not necessarily be as robust as you might expect to see in a larger organisation. So, Jackie, thanks so much. I think that's been a very informative discussion today, and we very much appreciate your insight. I think perhaps a point to leave our audience with today is to not stick their head in the sand and confront these things, get robust professional advice about their options and the steps that can be taken, or whether there might be some availability for a defence to be raised. And finally, I think an important point that you have raised is to look to engage with the ATO as soon as possible and as proactively as possible. And in that regard, especially your compliance record and history as a taxpayer may become a very important factor. So thank you again, Jackie, and thank you to our audience for listening in on this first in our current series of tax records. We hope that the information we've provided today and in all of our podcasts is useful. And of course, as always, everybody is welcome to make contact with one of our happy and friendly tax team members to discuss any questions. All of our details can be easily found on our website, www.hallandwilcox.com.au, or you can connect with us on LinkedIn. And if you've enjoyed today's episode, and hopefully you have, please rate, review, and follow our podcasts on whatever medium it is that you use to listen to podcasts. Thank you again. And of course, you can subscribe on our website to be notified of our upcoming episodes.